setups. I will give you an example on the euro-US dollar we had on this particular pair last week on 11th June 2025. So in this video we'll talk about the importance of using the lower time frames combination, especially in order to trade those high probability trading setups. Not every trade is high probability setups, and with experiences, your job, your homework is of course to understand the difference between high probability and low probability setups in order to focus, in order to execute those high probability trading shots, trading opportunities consistently. Starting off the hard time frames, the daily time frame, our trading idea was to look for short trading setups, because on the daily, yes, on the daily we have this bullish structure, but here over the short term we had this weakness. As you can see, we had this weakness, price was retracing, and therefore our idea was to look for potential short opportunities. Previous short term lows were broken to the downside, price formed, as you can see, a new sell side liquidity levels, and our idea was to look for possible continuation towards that sell side liquidity levels. Now ignore those last few days, because our focus is over here, where our idea was to look for short opportunities. That's everything we had to know of the daily time frame. The 4-hourly time frame, what was the structure here? Just by looking at the classic candles, by looking at the raw price action, you can see that if we focus here, this was our swing high, the buy side liquidity, and market was moving to the downside. Price broke, as you can see, all those short-term liquidity levels, the previous swing lows, and price, as you can see, formed this another new fresh swing low. This was our sell side liquidity level down there. So as price retraced, it formed another buy side liquidity level, the new fresh swing high. And if you check where this swing high is holding, you can see that on the breakout to the downside, price formed this bearish imbalances, the 4-hourly bearish fair value gap levels, and on this day, as you can see, on the 11th of July, our idea was to look for potential retracement back into that liquidity pool. Why liquidity pool? Because as you can see, we had this previous swing high working as a buy side liquidity level. We had this second bearish imbalance, the 4-hourly fair value gap levels, and our idea was to look for possible rejection of those levels in combination with lower time frames in order to trade potential continuation, trying to target these previous 4-hourly swing lows working as a sell side liquidity down there. So once the price was approaching those levels, that's where our focus is back on the lower time frames in order to look for lower time frames structure shifts there. So this is everything we had to know of the 4-hourly. So if I use this just to mark those levels where you need to focus on, if you go to the 15-minute time frame and if you scroll back, you can see how beautifully this price action was there, how beautifully price came back towards those liquidity levels up here, and then we had rejection to the downside. Now this was on Friday, in the late Friday in the New York session, and as you can see, those are the levels we just marked before. We have 4-hourly buy side liquidity, the previous lows. We have this bearish imbalance here as well, and we have also Asian session range highs up here. So price in the London was slowly delivering towards that liquidity pool, and our idea was to look for a rejection of that level. So if price is coming to those levels, we need to see liquidity sweep, and then possible rejection to the downside in order to trade continuation. Now this is where you have to really be careful of lower time frames setups and compare it with the higher time frame. So what do you see here? What do you see here is beautifully bounce of that bearish imbalance confirmed with bearish fair value gap zone on the 15 minute. As you can see, price broke these short-term lows. If I zoom in, you can see price broke this short-term low. After liquidity was taken, price pushed to the downside, and we had nice confirmed bearish setup here. But one thing you need to be really careful of if you want to avoid low probability setups is when you are trading the 15 minute short-term setups, short setups here, as this for example, you need to be aware of the sell side liquidity levels on the 1 hourly time frame or even 4 hourly. So just by looking at the 1 hourly time frame here, what do we see here? This green line, this is the previous 1 hourly swing low, which means this is the 1 hourly sell side liquidity level. So do you really want to trade? Do you really want to trade, let's say, 50 minute short setup against 1 hourly sell side liquidity level? Of course not, because most likely if you see 1 hourly sell side liquidity level very close by, and if there is not enough room for risk and reward ratio, a lot of time it will happen that 1 hourly sell side liquidity will be taken out, you will go short, and then you will see price moving in the opposite direction. So in this case, you're trading the 15 minute setup, for example, in this case, against the higher time frame 1 hourly sell side liquidity level. So if you have a short setup here, you need to be aware that this sell side liquidity is working there as a support. So it's very likely that price will try to reject that level and then move back up higher. And this is exactly what happened here on the euro-US dollar. That's why we avoided, we didn't take this 50 minute setup, because once the 1 hourly sell side liquidity is taken, you don't want to go short on the 50 minute setup. It will be different if sell side liquidity will not be taken, if 1 hour sell side liquidity will not be just few pips away, and in this case you could look for an entry. But in this case, this was the 1 hour sell side liquidity level. You have this confirmation here, and if you will look for entry right here with a stop loss of 30-31 pips, risking that short-term high, the high of the day, targeting those levels down there. In this case, your entry would be right 1-2 pips away from that 1 hour sell side liquidity, and that's why we didn't take this one. This is a low probability setup, and you have to be really aware if you want to increase your win rate, if you want to hit more winning trades than losing trades, and you want to avoid those losing trades, low probability setups, you need to be really aware of 50 minute time frame, 1 hour time frame when you're trading, for example, this combo here. So in this case, you would look for short here against the 1 hour sell side liquidity block. So this is very low probability setup, and in most cases you will see price reversing heavily on those levels. And that's why you have to be really careful. You need to gain experiences, you need to understand, and need to compare the higher time frames with the lower time frames in order to increase your win rate, in order to be more successful on the long term. Now, for example, if let's say 1 hour sell side liquidity will be, let's say, somewhere here, if you would see, let's say, price creating that sell side liquidity and then hitting that higher time frames liquidity pool, and then you will get rejection of the lower time frames, then of course it will make sense maybe to look for let's say 1-to-1 risk and reward ratio. But in this case it's very different when 1 hour sell side liquidity was very close by, so this is really low probability trading setup, and you need to be aware of those setups in order to avoid them. Just focus on less trades every week, pick your shorts carefully, and focus on good setups that make sense in terms of risk and reward ratio. So hopefully this video was helpful. Thanks for watching, and we catch up soon. Take care.